Hello from the Dukascopy TV studio in Geneva. I'm Daniel Schwenger. Alongside me to discuss counter-cyclical investments in climates of unsteady markets is Mirco Coccoli from MPD Partners in Geneva. Mirco, welcome to the studio.
Thank you for receiving me here in the studio.
Well, in dark and gloom economic outlooks, in recession times, counter-cyclical investments promise above average gains. So what is your company especially focusing on?
We focus on investments that are a maximum in companies that have a maximum of 100 million in revenues, so they are all not on public markets, and in real estate. We do real estate because in the type of company we normally deal with, so the SME environment, very often we find real estate in the books, and we think that it's good to keep the skills. In the terms of why we do this, with respect to the current economic outlook, is that we think that this market is especially non-correlated with the global economy. We think this because we find that the type of inefficiencies we find, especially on the SME, in the SME environment, are very strong inefficiencies. When we say inefficiencies, it means that companies tend to be owned by family businesses, for example, to be large family businesses, and very often the type of academic education and in overall, as an aggregate of the company management, is not that staffed, meaning that, of course, the company is smaller, you have less people. First. Second, because the company has a smaller size in revenue, so in sales in the market, they typically deal with higher potential margin than large companies, or less volatility in margins, and, higher volatility in margins than large companies. And of course, if you select the right company, you can find the pearl, what we call the pearl.
And so if you are focusing on these outstanding companies, also investment opportunities, what are your core principles and what is your time frame for investments?
Yeah, starting from the time frame, actually, we think that we try to be short. We are in a private equity environment, and private equity environment typically has a liquidity problem, and the trend is to improve liquidity, so to reduce the time frame. So we try to go from 3-4 years to 6, and of course we know that the exit, it depends on which moment of the global economy the exit will be, because even if you're performing well, you need to know that everything depends on how much money are out there to actually perform an exit, and it depends on also the exit you want to do.
So in the current economic climate, how do you evaluate the current investment possibilities? Would you rather invest in private equity, in real estate? Would you go for venture capital?
Private equity had a record year and a half, let's say 2013 and the beginning of 2014 so far. So a record in fundraising and a record in closed funds. There is a lot of what's called dry powder in the funds, so it means fresh cash that can be deployed. And but this has create a little problem of high valuations. So that's a kind of dangerous, I would say, for regular private equity, so large deals. When you are in small companies, well, it doesn't matter the period, the moment, the economic moment in which you are actually investing. So today is fine as any other moment. You need to be careful when you go into venture, because if you are in the large type of venture, in venture you can have the same phase of the company for companies that have a value of 4 million and 40 million. So when you go in the large ones, valuations, we think they are high in this moment, especially in most sectors. For what concerns the small companies, there you can a little bit play a different game. It depends on how much added value as a private equity advisor or private equity firm you can actually give to a company. Real estate is dangerous in general, because nowadays, in this economic moment, because in many countries it's expected to be the next bubble to explode. We actually didn't look too much into the details of that, but we were searching into the real estate sub-asset classes to understand which asset class is more interesting. And we found that the result of our research is in line with John Lang LaSalle and Knight Frank, and is that you need to look into what's called counter-cyclical or recession or recession hedge type of real estate investment. And that means, first of all, we want to look into markets that have a demand that increase when there is a potential or ongoing recession. And second, what is important for us that we need to plug into this concept is the fact that we need to show cash flows. This is why we do income real estate, meaning we need investors to be always very well informed about how the real estate, their real estate investment is going. So, what are the books?
So, if we take technologies, sectors, which counter-cyclical investments do you see as interesting opportunities in the future?
Regarding the venture area, basically there are, first of all, you have the typical subdivision we said earlier in the interview. You need to be careful with large venture. It's good to have a venture in which you can see already something of the company, so what we call late stage or almost growth, when we try to transform negative EBITDA to a positive EBITDA. And then try to find what we mentioned before, pearls. So good managers, good cost basis, a good margin, and a stable way of managing the business, even if it's small. What we do not like, for example, in the venture arena, is empire building, so trying to build the next Facebook.
So large potentials ahead to invest. Mirco Coccoli from MPD Partners, thank you very much for your visit and expertise and sharing this expertise with us here today.
Thank you, Daniel.
And thank you very much for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. See you next time and have a great day.